So far in this course, we've defined wealth as what we're working towards, which represents the freedom to do what we value most. We've discussed why we invest, because it can turn ordinary effort into extraordinary results. And we've talked about what investing isn't, and how, if done properly, we shouldn't lose sleep over our process. In this lesson, we're going to answer the big questions: what it is and how it all works. Investing is the act of putting in a measurable effort in the short term with the reasonable expectation of earning a disproportionately large return in the long term. Essentially, putting in a smaller amount of effort now for a larger return later. Using this definition, someone can invest in a variety of different areas of their life, like education, health, fitness, hobbies and interests, or what we're going to be focusing on: finances. Although someone can invest in private companies, real estate, or other financial means to grow their money, the majority of people invest in stock and bond markets. So that's going to be the focus of this course. Markets are used by companies and governments to raise capital to fund new projects, research, development, pay off debt, or simply increase cash on hand. They raise the capital they need by selling small portions or shares of the company to investors. For example, right now Apple has over 15 billion shares on the market. When an investor buys a share, they really do become a part owner of that company. They've exchanged their money for a piece of ownership, also known as becoming a shareholder. As a shareholder, you may get voting rights, but what you really want is a financial benefit from being a partial owner. This may include dividends, which are regular payouts from profits for each share that you own, and hopefully this includes appreciation, the increase in value of the shares that you own because the company is increasing in value. Sticking with Apple, they currently are paying a quarterly dividend of 25 cents US dollar per share, which doesn't seem like a lot, but when you own a lot of shares, it can really add up. Berkshire Hathaway, Warren Buffett's company, earns nearly $800 million annually from Apple dividends alone. But believe it or not, that hasn't been the main advantage of owning Apple shares. Since Buffett first bought in 2016, Apple is up over 800%, which is over 4 times the return of the S&P 500, which represents the 500 largest publicly traded companies in the US. Since stock markets operate under supply and demand, if you're going to invest, it makes sense that you want to invest in profitable companies with great long-term prospects. The truth is that everybody does. When a company has success and has a real plan to have even more success in the future, they become a company that everybody wants to invest in. If there's a strong likelihood that a company's shares will be worth more in the future than they are now, it makes sense to buy today and buy as much as possible. Management, earning reports, economic policy, politics, and a bunch of other variables can play a part in influencing a company's share price. But we can simplify this. Morgan Housel wrote, "Every forecast takes a number from today and multiplies it by a story about tomorrow." Stock prices don't always move rationally. We see that all of the time. Sometimes what moves stock prices the most is what we think might happen, or more dangerously, what we want to have happen, which rarely turns out to be the case. As a shareholder, you're also a partial owner of the company when things aren't going great. You may see your investment in a company actually decrease in value, or see your dividend payments stop completely if a company is going through tough times. The worst case scenario would be losing your entire investment in a company if they were to fail or go bankrupt. This is why there's an increased reward around being a shareholder of a company, because as a partial owner, you are taking on additional risk. More risk, more reward. Bonds are similar, but instead of representing ownership in a company, they represent an obligation to repay you. You are essentially borrowing the bond issuer money, and in return they promise to pay you interest. Bonds are typically issued by large companies or even governments, so they are viewed as less risky than owning shares in a company, and appropriately so, they pay you a smaller return. Although the stock market gets all the attention, the global bond market is actually quite a bit larger than the global stock market. There are 2 other major asset classes that we can mention: real estate and cash. Real estate investment trusts, or REITs, allow people to invest in real estate similar to owning a share in a company. It's like being a landlord without having to be a landlord. REITs can be great because happy paying tenants find a risk and reward level in between stocks and bonds, and can provide a stabilizing element to portfolios. Cash, on the other hand, really offers no financial benefit. It's what you'd hold in a high interest savings account, likely earning a return less than inflation. The benefit here is that there's no real risk, other than losing purchasing power to inflation. So holding cash is often best for short-term goals, when you don't want to risk having less money than you do right now. At this point, I'm sure you're wondering how to know what you should invest in. So let's talk about that. Your ideal mix of stocks, bonds, real estate, and cash come from two main measures. One, your risk tolerance, and two, your time horizon for reaching your goals. Since our four asset classes move in different ways, stocks having the highest return potential but the most volatility, real estate a little less so in both fronts, bonds having the most stability while offering more conservative returns, and cash not really doing anything for us, we have to be comfortable with the expected movements of our portfolio. We want to invest for as long as possible. If our portfolio of investments keeps us up at night and makes us want to quit investing, that goes against that intention. The second consideration is our time horizon. Overall, investments move up and to the right, but the journey there isn't always a straight line. The best visual that I've ever been told is to imagine someone playing with a yo-yo while going up an escalator. The yo-yo, which represents the market, will experience short-term ups and downs as it moves. But when we zoom out to take in the entire escalator into our perspective, we can see the bigger picture and the trend that we're hoping to see. What we want to avoid is a situation where our investments are down when we need them the most. This is more pressing as our goals appear on the horizon. In order to avoid this, we want to consider our personal risk tolerance, the timeline that we will be investing for, and also our financial capacity to manage risk. For example, you might be more open to taking on increased risk with the chance of increased rewards if you have a comfortable cash flow, plenty of savings to make up a gap, or if you're okay with pushing back a goal. Luckily for us, investing has never been easier or more accessible. There are two main ways that someone can invest, either on their own or using a professional. Investing on your own can be as simple as having pre-authorized contributions automatically invested, very hands-off after the initial setup, or as complicated as buying and selling individual stocks, very hands-on after the initial setup. The pros with investing on your own is typically limited to lower fees, whereas the cons can be quite extensive depending on your situation. Choosing or not choosing the right investments can be the difference in hundreds of thousands of dollars for a typical Canadian. We'll talk about this more in the Canadian specifics chapter, but we have access to a variety of different accounts that we can invest in, each with its own pros and cons. Investing in the best account can result in a huge difference in the total tax you pay throughout your life. Generally, investing on your own lacks the planning aspect and focuses on chasing returns, something that we want to move away from as long-term investors. The biggest con about investing on your own, in my opinion, is that investing goes against a lot of our instincts, and it's easy to make mistakes that are only fully realized in the long term. Something that we'll dive into deeper in the behavior and investing chapter. But often our biggest obstacle in the way of being a successful investor is ourselves. Using a professional can solve a lot of these problems, but not necessarily. Just like any profession, there isn't a universal standard, so not all financial planners or financial advisors are created equally. Using a professional will obviously come with a higher fee, but the right advisor can make up for that fee that you pay and then a whole lot more. Vanguard, one of the world's leaders in investment solutions, estimates in their Advisor Alpha reports that a good advisor can add over 3% to an investor's returns. The majority of the value comes from three areas: behavioral coaching, asset allocation, and spending strategy. When choosing how you want to invest, it's important to consider how much time and work you want to spend on your investments, or if you'd rather spend your free time doing other things. You also want to consider how likely you believe you are to build a plan that will accurately reflect your values and what you want to work towards. And finally, your ability to stick to that plan during tough times, like a recession. Regardless of how you choose to invest, there are three main types of assets your money will ultimately be invested in: individual stocks or bonds, exchange traded funds or ETFs, or mutual funds. Individual stocks and bonds are exactly what they sound like. In this approach, your money would be used to buy shares individually, having to choose the number of shares and which company with each transaction. Your asset allocation and diversification would have to be top of mind to ensure that shares are bought and sold while maintaining your ideal mix. An ETF is a basket of partial shares that trade similarly to an individual stock, but they come with asset allocation and diversification in mind. ETFs come in all shapes and sizes and can represent ownership in thousands of different stocks and bonds across the world. Since they are partial shares, a share in an ETF is often the same price as buying anything else. ETFs typically come with low fees and follow the overall movement of the market. Here you're not trying to beat the market, just match it, knowing that historically the market has produced phenomenal returns. Mutual funds are similar to ETFs, but the major difference is that mutual funds are typically actively managed, so they come with much higher fees than ETFs. Historically, the majority of mutual funds have underperformed their benchmark, which is a measure they use to compare how they've performed. This is mostly due to 1. The higher fees. If you pay 2% in fees each year, then the fund needs to beat its benchmark by 2% just to match it. And 2, that unavoidable fact that humans make errors and that the markets are unpredictable. What we believe will happen doesn't always turn out to be the case. How we invest can take different shapes and forms, but the most important thing, as we'll see shortly, is that we put ourselves in a position to be able to invest for as long as possible. Our approach needs to be designed to be sustainable for the long term, and that means aligned with our risk tolerance and our goals. We also have to recognize that we can only make a best decision with the information that we have at any given moment. As that information changes in the future, we can adjust our approach to always reflect our best interest.